How does the IRS treat debt cancellation? Have you ever wondered what happens when a lender decides to forgive your debt? It might sound like a relief, but it can come with some unexpected tax consequences. When a lender cancels, forgives, or discharges a debt, the Internal Revenue Service generally views that amount as taxable income. This means if you owe money and the lender says you do not have to pay it back, you may need to report that forgiven amount on your tax return as if you earned it. Typically, the lender will send you a Form 1099-C, which reports the canceled debt to both you and the Internal Revenue Service. This form is important because it outlines how much debt was forgiven and serves as a record for your tax filings. However, there are important exceptions to this general rule. One major exception applies to individuals who have filed for bankruptcy. If your debt is discharged through a Title 11 bankruptcy proceeding, such as a Chapter 7 or Chapter 13 bankruptcy, the canceled debt is not considered taxable income. This is a significant benefit for those who choose bankruptcy as a debt relief strategy. The Internal Revenue Service understands that bankruptcy aims to provide a fresh financial start, and taxing the canceled debt would undermine that goal. Another exception comes into play if you can demonstrate that you were insolvent at the time the debt was canceled. Insolvency means your total debts exceeded the value of your assets. If you were insolvent by a certain amount, you may not have to pay tax on the canceled debt, even if you did not file for bankruptcy. When it comes to debts secured by property, the Internal Revenue Service treats the situation differently based on whether you were personally liable for the debt. If you were personally liable, known as recourse debt, and the creditor takes the property to satisfy the debt, you may have to report a gain or loss on the property as well as any canceled debt that exceeds the property's value. If you were not personally liable, known as non-recourse debt, the rules are simpler and generally do not result in taxable income from the cancellation. If you are considering bankruptcy as a debt relief option, you can feel confident that debts discharged in bankruptcy will not create a new tax bill for the canceled amounts. This is a key reason why bankruptcy is often chosen by those with overwhelming debt. It not only provides relief from creditors but also avoids the tax consequences that can come with other forms of debt cancellation. Understanding these rules helps you make informed decisions about debt relief strategies and their tax consequences. For those who qualify, bankruptcy offers a clear path to eliminating debt without the added burden of a tax liability on the forgiven amounts. Always consult a tax professional or bankruptcy attorney to ensure you fully understand how these rules apply to your specific situation.